Hey everyone, it's Tim. I came across some pretty shocking numbers and want to go through some of that with you right now. First, the average American credit card balance is at a record of $7,300. The median household has only about $5,300 in savings. For the first time in history, total credit card debt is about to cross $1 trillion. And what's the average rate on all that credit card debt? 24.2%. We've all noticed things getting more expensive recently. And what the data shows us is that people are paying for those cost increases with debt. And what the data is telling us is that maybe people are having a hard time with that debt. The delinquency rate on credit cards is almost at 3%, and that's gone up for 6 straight quarters. Now, why do I bring this up? Well, everyone is super, super proud of that really low interest rate that they locked in on their mortgage in 2020 and 2021. You'll actually hear some people bragging about how low of an interest rate they got, which is kind of funny because whoever thought that we'd be bragging about anything mortgage related. But anyway, now why do I bring this up? Well, yes, the interest rate on your mortgage might be super low, but what if I asked you what your blended rate is? Do you know what your blended rate is? Do you know how to calculate your blended rate? What a blended rate is comparing your mortgage plus all your other consumer debt and combining it all to figure out what are you actually paying for all your combined debt. With consumer debt going kind of crazy for the last 18 months, I think it's a good idea to look at your blended rate on all your consumer debt. And how do we do that? I'm going to show you a really simple trick. Check it out. First thing we do, we open up our ChatGPT prompt here. If you've used ChatGPT before, you know how this works. If you haven't, just check it out. It's really simple. Log into your account. And let's put in a scenario. Let's say if I have a mortgage of $300,000 at 3% interest and credit card debt of, let's say, $65,000 at 24.99% and an auto loan of $45,000 at 9.5%. What is my blended rate? These are all just numbers that I kind of made up, but you can see how it all works and how it calculates. To calculate the interest for each debt, you can see how the numbers go here. Basically, what it's saying is when you combine all your debts, the total interest on the debt that you're paying is about 7.19%. So even though the rate on your mortgage is really, really low, it's being offset by all the other debt that's out here. So what do you do if you're somebody that has a really low mortgage rate, but kind of a high blended interest rate? There's lots of different options of what to do, but I'm going to cover 4 that I think of off the top of my head. Number 1, do nothing. Keep paying your mortgage at a low interest rate. Keep paying your credit card at a high interest rate. Keep paying your car loan at a high interest rate. Try and knock down that high interest rate consumer debt as quickly as you can, and eventually you'll chip away at it. Option number 2, you've probably seen house prices have continued to go up. I hear people all the time that say, I can't believe the house down the street from me sold for as much as it did. Those high sale prices help owners because it helps build equity in their home. So although everyone hates to hear it and hates to think about it, what if you refinance that low interest rate on your mortgage to a higher interest rate, but that allowed you to take equity out of your home and pay off $50,000 or $60,000 in credit card debt that's at 24, 25, 27% interest? You're not going to be able to brag about your low interest rate on your mortgage anymore, but the interest on all your total debt as a combined number might be lower, and that certainly may help to lower your monthly bills. Option 3, what about keeping your mortgage and instead getting a home equity loan or home equity line of credit? This allows you to keep your first mortgage at that low interest rate, but then tax on a second mortgage behind it. And what you do is you take the money that you borrow from that line of credit and pay off all that higher interest debt that you have. Now, when we compare the interest rates on these different types of loans, the lowest is probably going to be what your current mortgage is. The next lowest would be if you refinanced and what that new mortgage payment would be. A little bit higher than that is probably going to be the home equity rate up here. And then way up here is that credit card debt that you have. So everyone's situation is going to be a little bit different. For some people, it may be cheaper to refinance that first mortgage and take a hit on that interest rate and end up paying something a little bit higher. For some people, it may be cheaper to keep that mortgage and just get a small home equity at a higher rate, but using that money to pay off other higher interest debt. And then option 4, yes, there's way more than 4 options, but I'm just covering 4 here, is sell your house. Now, this isn't for everybody. I think it generally falls into 2 categories of people that this might work for. Number 1 are people that are completely over their head and overburdened with other consumer debt that they have. If it seems completely hopeless of putting a plan together to pay off that debt, and maybe you can't refinance because you've got so much debt, you've got some late payments, those delinquencies that I talked about before, maybe that's wrecked your credit score, so now you can't even qualify to refinance. Maybe that's a situation where you have a lot of equity in the home, but you can't really get to it unless you sell the house. Think of it like a big reset button. You sell the house, take all the money that you get from the sale, pay down that debt, pay off that debt, watch your credit score improve and increase, maybe save a little bit of that money on the side and use that as a down payment for another house when you're ready to buy again. And the other type of consumer that I can see possibly selling a house to pay off that debt are people that maybe they want to move. Maybe they've felt trapped in their home because they thought there's no way we can leave this house, not if we're going to have to get a new house and pay who knows how much for it, and the interest rate is going to be a lot higher than we have. We can't afford to move. We have to stay where we are. So instead of feeling trapped in a home that you don't want to live in anymore, what if you sold the house, took the proceeds from the sale and used a chunk of that to pay off all that high interest consumer debt that you have? You can still save some money from the sale to go towards a down payment towards a new home. And even though you're borrowing more money on a new mortgage at a higher interest rate than what you have, your monthly cash flow for the household might actually be better compared to having all that other consumer debt out there. That's not only really expensive to pay each month, but also you don't really have a plan as to how you're going to pay off all that debt, especially if it's credit card debt. So I hope this helps. Maybe that's an easy exercise you can do. Just go to ChatGPT, throw in your scenario, how much you owe, what interest you pay on whatever kind of debt you have, and let that AI system calculate what your blended rate is. Now that you know your blended rate, you can kind of make decisions on what to do if you have a lot of consumer debt and want to figure out the best way to get that paid off. If you have any questions on this type of stuff, let me know. I'm happy to help out. Thanks.